For other transaction relating to accounting for retailing, we have other three types of transaction. Number one is receive payment of cash, yeah, from our customer. This is number five. Sorry, number six, make payment to suppliers, and to record the stop loss. So these are the balance of the remaining, yeah, transactions. For the receive payment, yeah, you can receive payment but you don't give any discount, or maybe you receive payment but at the same time you give discount to your customer for early payment. That discount is known as discount allowed. When you make payment, sometimes you get discount, sometimes no discount. If you get discount, that discount is known as discount received for early payment. Okay. So, for example, when you receive cash payment from customer, you have this customer before this, you sold 5 unit at price of 80. So you sold for 100, he returned to you 1 unit, so the amount outstanding is 320. I repeat, you sold this one to Mr. A for 100, he returned to you 1 unit, 80, so the outstanding balance is 320. You sold on credit to Mr. A. Now, you receive the payment, so your cash increase. Your cash increase, debit. Your account receivable decrease, so you're going to credit your account receivable. Cash increase, debit. Account receivable decrease, credit. Yeah. So how are you going to do this? Very simple. The journal entry will be cash. In this case, no discount. Cash, debit 320, account receivable, credit 320. In certain instances, okay, in certain instances, you will receive payment early than what you normally expect. So in that case, you're going to give discount to your customer. So in this question, in the first one, no discount given. The payment is after 3 weeks. After 3 weeks, too long, no more discount. Let me just repeat. You sold 400 to Mr. A. He returned one item 80 to you. So the outstanding balance, the balance of your account, the Mr. A account receivable is 320. That's why you receive the cash, the full amount 320. In this another example here, the same situation but different situation. Yeah, same figure. You give a term here 5%, 5 stroke 10 and 30. It means that if Mr. A or the customer paid within 10 days, you're going to give them 5% discount. This is 5% discount for early payment. Otherwise, they have to make the payment before within 30 days. So this create incentive to pay early. If Mr. A make the payment within 10 days, you're still going to receive your cash, but not 320. Your cash will increase. So you're going to debit that. Okay. And then you're going to give the discount. That will be your expense. The discount allowed is your expense. You're going to debit. And you're going to reduce the account receivable. As you're going to credit account receivable by 320. So in this example, the balance is 320. Since the payment is made after 5 days, yeah, you are giving them 10 days, but Mr. A paid within 5 days, so you're going to give them discount. How much is the discount? 320 multiplied by 5%. So they get discount of $16. Okay, this is a lot, yeah. 16 dollars. So this is your expense. This I call it expense. So your expense increase debit by $16. How much cash you're going to receive? You only receive cash 304. Yes, the loan, the balance account receivable is, this is the AR balance 320. You give discount 16. So you're going to receive cash only 304. This is the cash receipt. So debit cash 304, credit expenses, discount allowed 16, and the account receivable, you're going to minus the balance, that is 320. So credit account receivable by 320. So this is a good example for when you receive payment by cash from customer, and you also give discount to them. In other example, we also can make payment. Okay, there's a question, what is N30? N30 is the term for the credit where it requires the customer to make payment within 30 days. Within 30 days. Okay. Make payment to supplier by cash. Okay. If you still remember from our example, we purchased 20 units, we return 1. So for the 20 units, our account payable is 1,000. If I put the account here, this is our account payable. We have 1,000, and then we have credit 50. So the balance of our account payable is 950. We don't have enough cash to make early settlement, so we only pay after 3 weeks. So no discount to us. So what will be the transaction once we make the payment to the supplier? So our account payable will decrease. So I'm going to debit here 950. I'm going to record this as cash. And my cash will also decrease or credit by 950. So the transaction will be debit account payable 950 and credit cash 950. Debit account payable 950 mean reduce of liability, and credit account payable mean credit cash mean reduce in cash, reduce of cash, yeah, by 950. So this is transaction number 6, yeah, payment to supplier, yeah, by cash, no discount given. What if the same example here, you able to get discount from your supplier? They give you term 2/10 and stroke 30, mean 2% discount if paid within 10 days, otherwise 30 days. So if you make payment within 10 days, they're going to give you 2% discount. So what are the effect of this transaction? When you make payment, your account payable will decrease, debit. When you make payment, your cash will also decrease, and when you receive discount, that will be your revenue. So it's going to be credit. This is your revenue. This is your revenue. Yeah, I call it revenue, income. Okay. So after 6 days, you make payment to supplier for outstanding balance. What is the outstanding balance? 950. So this is your outstanding balance 950. What is the discount? 950 multiplied by 2% is equal to $19. So this is discount. You don't have to pay full 950. You only pay, this is your balance outstanding, and this is your liability. This is your liability 950. You get discount 19, so you only pay 931. So this is your payment by cash. Your cash reduce, your revenue increase, and your liability decrease. Yeah, liability decrease, debit account payable, credit revenue 19, and credit cash 931. So I want you to remember these transactions, yeah? This transaction and example how we solve these transactions. The last transaction will be our stop loss. At the end of the month, when you check your store, you found that one calculator is missing, was missing, yeah? One calculator was missing. So how to record this? The calculator was missing. So your inventory reduced by 50. So that's why I credit my inventory reduced by 50, and this loss will be your expense. This loss will be your expense. So I'm going to debit inventory shortage expense. This will go to your income statement. It will reduce your profit, and I'm going to credit the inventories been reduced in your assets. So every time you lost your inventory, okay, or there are damages inventory, so you're going to debit inventory expense, inventory shortage expense, and credit your inventory balance. Yeah, by 50. This one is given in this example. The last part will be the transportation cost or the freight outwards. So there are a variety of costs related to moving goods from seller to buyer or from, yeah. So normally we have two standards trade term. Number one is X work or EXW, where buyer paid the shipping. So if your buyer need to pay the shipping, you as a seller, you don't record, because this is not your business. This is other party's business, because buyer will pay for the shipping. Another one is delivered duty paid, means seller pay the shipping. So if you are the seller will record this. Okay. If you are seller will not record the X work, mean no journal entry, but the buyer have to record. How to record this one? The freight cost, debit, credit, cash. This is for buyer. If the seller need to record, they're going to debit the freight expense, debit maybe 100, that's 1,000. 100, and credit cash. If you payment by cash, it's going to be credit cash. So you have to be very careful whether is X work, EXW, or DDP. X work means you're not going to pay, the buyer will pay for the shipping cost. What are the transactions? Debit, freight expense, credit, cash. If you need to record. Depends on the question whether you are buyer or you are seller. Be careful on that. Okay. So accounting for purchases and cost of sale, this is for if you are using a different method. I call it as periodic system. We need to record a different style. We don't maintain our inventory and also our cost of sales. So for perpetual, this is the summary. Okay. Involve keeping running record of each purchase and sales. Every purchase and sales, you need to record the inventory, you need to record the cost of sales. So we have inventory account and cost of sale account is updated. The inventory account and cost of sale account is updated after every purchase or sale. As a result, the balance in the inventory account is the ending inventory amount. So this is a very good system, that is perpetual inventory system. Normally, if you use computerized accounting system, they will give you this result. Yeah, this is the ending balance of inventory. Ending balance of inventory. Okay. A stock take is only performed. What is stock take? The physical count of stock. The stock check is only performed to verify the accuracy of this recorded ending inventory. They still do the stock check, but to check whether the record is tally with the physical quantity. Physical quantity. If the recorded inventory and stock take differ, then an entry to record the correct amount need to be processed. Normally, you're going to record it as stock loss, the difference. That's one system. Another system is we have periodic system, whereby this is much easier system. You don't have to maintain, don't have to maintain the cost and inventory account. You don't have to maintain the cost inventory account, because under sales and sales return, you need to record two journal entries. So it's quite difficult for some businesses. So they use a simpler method, that is periodic system. So under periodic system, no running record for each purchase and sale. Okay. Additional inventory purchase is recorded as purchases. They use purchases account instead of inventory. They don't use inventory account. They don't update the inventory account. So because of that, the balance of the inventory account is not up to date. The balance is not up to date. The balance of inventory account is not up to date. Not up to date. So it's not good, yeah? But it's easy. So every time you want to know your balance of inventory, you have to do your stock take. Stock take is performed to determine the balance of your inventory. So the closing balance is then used to determine the cost of sale. How to determine cost of sale? By using the closing balance. Okay. So let me show you this formula, yeah? For example, your opening inventory is 0. You don't have any inventory. Then during the year, you purchase inventory 900. Okay. So your available inventory for sale, I call it available inventory for sale, is 900. Am I right? You don't know how much you have sell, but when you do your stock take, you minus your closing stock, closing inventory, you found that you have balance of 200. So what is this 700 mean? What is this 700 mean? I repeat, you have your opening inventory is 0. During the year, you purchase inventory worth 900. And at the end of the year, you found that you still have balance of inventory 200. So what is the 700? What is the 700? Inventory sold. Very good. So this is your inventory. Balance 0 plus 900. Okay. 0 plus 900 is your available inventory. 200 is unused, unsold. And this is your assets at the end of accounting year. 200. So the balance, so the 700 is what we call as the sold item, sold or cost of sale, cost of sales. Yeah, sales. So in periodic inventory system, in order to determine the cost of sale, you have to use this formula. What is the formula? Opening inventory plus purchases minus closing inventory, you'll get your cost of sales. So every time you want to determine your cost of sale, you have to check your inventory balance, the closing inventory. You have to go to the store, check your closing inventory balance. Closing inventory balance. Then you will get your cost of sales. Compared to using the perpetual, at any point of time from the accounts, you know what is your cost of sale, what is your inventory balance. So how does this system work? Okay, for purchase, instead of debit inventory, we use inventory in our perpetual inventory system. Under periodic system, they don't use inventory here. They don't keep any inventory, so they just record it as purchases. Debit purchases, credit account payable. If you pay for the transportation cost, then you're going to debit freight inward, credit cash, and bank. Debit freight inward, credit cash, and bank. Okay. When you receive, yeah, when you create sales, when you have sales, is usually we have debit account receivable or cash. This is just example. This is just example, yeah. Example. I'm showing you the journal entry. Debit cash 400, example, sales 400. Okay. In perpetual, we also need to do adjustment for cost of sale and inventory. But here, under periodic, you don't do this step. Yeah. For purchase return, we don't have this. Still remember, if you have this, this is under periodic system. We only record the first part. This is the first part. We don't record the second part. What is the second part? Debit, cost of sale, debit, credit, inventory. So because we don't have the cost of sale, we don't have inventory account. So it's very simple. Okay. For account payable, when you do purchase return, we don't update our inventory. Normally, we're going to reduce our inventory. This is our inventory. In the periodic, now we don't include our inventory. We have a new account that is purchase, return, and allowances. Purchase, return, and allowances. The payment is the same. It's the same, no different. Okay. For sales return and allowances, it's the same. Sales return and allowances, debit, for example, 80. Credit account receivable 80. So this is the first step. This is the first step, yeah, number one. For number two, they don't have the number two. In perpetual inventory system, we have debit inventory, debit, and credit your cost of sale, credit. This is perpetual. So we don't have the inventory and perpetual, so it's much easier. But don't worry so much. You're going to do this with Miss Yusra and Miss Avnit. So the financial statement will be like this. Sales less sales return. You're going to get your net sales. How to determine the cost of sale? You're going to use the formula opening inventory plus cost of purchase plus freight inward, the cost of transportation, the item, less the purchase return, less the discount, cost of net purchase, and then less inventory. This gives you cost of sale. So from cost of sale, you're able to determine your gross profit. Okay, so that is all about inventory for your final exam, for your midterm, for your final exam. You're going to be tested on the perpetual inventory system. Perpetual inventory system.
So, sir, we won't be tested on